Welcome to this session on the largest and probably the most confusing section of the foreign exchange market, FX swaps. Much of the material we'll cover relies on an understanding of the spot and forward market, which we covered in previous modules. Given the volume of materials to cover, I've decided to break this down into 4 sections. First, we will think about the logic for FX swaps, arguing they should be thought of as a form of collateralized borrowing and lending. In the second section, we will look at quoting conventions for FX swaps, introducing the concept of swap points. The focus of the third section is trading conventions, illustrating how the product could be used as a way of expressing views on movements of interest rates. The final section illustrates how the instruments can be used to manage the delivery dates of a currency receivable. By the end of the session, you'll be able to define what is meant by an FX swap and explain the principles of FX swap construction. So what is an FX swap? It's a contract to buy an amount of currency for one value date at an agreed rate and to simultaneously resell the same amount of that currency for a later value date, also at a pre-agreed rate. For example, an investor might buy euros for US dollars in the spot market, while simultaneously agreeing to resell euros at an agreed time in the future. The amount of the base currency, euros in this case, is the same in the spot and forward legs. However, the amount of the quoted currency, dollars, will be determined by the agreed forward FX rate. It is therefore a combination of a spot and an outright forward deal done in opposite directions. To use a previous example from the forward module, let us say that the euro US dollar was trading in the spot market at €1 equals $1 and at just over 8 cents. Delivery of the same currency pair 3 months forward was quoted at €1 equals 1.086. An FX swap might look as follows. The spot leg would be buy 10 million euros, sell 10,820,000 US dollars. Looking at the 3-month forward leg, we have a forward rate of €1 equals 1.086 US dollars. In the FX swap, the cash flows are reversed but are traded at the forward rate. So here we sell 10 million euros and buy 10,860,000 US dollars. Although the individual legs of the transaction will look familiar to those who've worked through the previous modules, the logic as to why someone might want to do this is not clear. Looked at horizontally, it appears to be a pair of FX transactions, which, although is correct, does not give us any real insight into the motivation. However, the vertical perspective reveals something different. On the spot leg, euros come in and 3 months later go out. That is a borrowing of euros. Dollars go out for spot value and then are returned at the end of 3 months. Well, that's a loan of US dollars. So now we can identify the motive more clearly. It's a euro borrowing collateralized with a dollar loan. I suppose you could think of it the other way, to say it's a loan of dollars with euro as collateral. The upshot is that the bank has swapped dollars for euros. This tells us that the principal use for FX swaps is nothing other than borrowing and lending on a collateralized basis. Looking at the magnitude of the cash flows seems to contradict this. The euro borrowing seems to have no interest cost associated with it. 10 million euros in, 10 million euros out. But the dollar leg has generated the bank money. Notice that the bank ends up receiving a net amount of 40,000 US dollars. To answer the question as to why this has occurred, we need to go back to the theory of forward FX rates. Here are the rates again. Spot is trading at just over $1.08 per euro, while the 3-month forward is €1 buys you 1.086 US dollars. In the forward module, we illustrated that the forward rate was based on the ratio of the interest rates in the respective currencies. Euro rates were 3.88% and dollar rates were 5.35%. The intuitive way to think about this is to see that the bank has borrowed the lower interest rate currency, euros, and lent the higher interest rate currency, dollars, and so in effect is earning that differential between the two currencies. Not convinced? Well, suppose I borrow 10 million euros for 3 months, a 91-day period, at a rate of 3.88%. I'll pay interest of €98,077.78 at maturity, and so the total amount repayable will be €10,098,077.78. If I lend the spot equivalent of 10 million euros, that is $10,820,000 US for the same period and earn 5.35%, then I'll generate interest of $146,325.47. I'll receive back a total of $10,966,325.47. Taking the ratio of the two at maturity cash flows gives us a value equal to the forward rate. That is, €1 equals $1.086. Here are 3 key takeaways. FX swaps are the largest segment of the foreign exchange market. They consist of a spot and forward transaction. Rather than think of them as a pair of FX deals, they should be considered as a form of collateralized lending and borrowing.